For decades, investors, business leaders, and everyday Americans have worried about recessions. A recession is something people understand. The economy slows down, unemployment rises, businesses struggle, and eventually the cycle resets. But what if the next challenge isn't a normal recession at all? What if we're looking at something much larger, something more structural, something that affects not just markets, but the entire financial system? That's the question I want you to think about today. Because when I study history, when I analyze debt cycles, and when I compare today's environment to previous turning points, I see warning signs that remind me of periods that changed countries, economies, and generations. Most people focus on headlines. They watch stock market movements, inflation reports, employment numbers, and Federal Reserve announcements. These things matter, but they are often symptoms rather than causes. The deeper issue is the growing imbalance that has been building beneath the surface for years. America has accumulated enormous amounts of debt. Governments have borrowed more. Corporations have borrowed more. Consumers have borrowed more. Debt can be useful when it creates productivity and growth. But when debt grows faster than income for long periods of time, the system becomes increasingly fragile. Eventually, debt reaches a level where it becomes difficult to sustain without creating new problems. What makes today's situation unusual is that we are dealing with multiple pressures at the same time. Interest rates remain significantly higher than they were during the era of easy money. Governments face rising interest expenses. Households face higher borrowing costs. Businesses face greater financing challenges. At the same time, demographic changes, geopolitical tensions, and technological disruptions are reshaping the economy. When several major forces collide at once, history shows that the results are rarely simple. Many people assume that central banks can always rescue the economy. Over the last 2 decades, investors have become accustomed to the idea that whenever markets fall sharply, policymakers will step in. During financial crises, central banks lowered rates, purchased assets, and injected liquidity into the system. Those actions often stabilized markets. But today's environment is different. Policymakers face constraints they didn't face before. If inflation remains elevated, they cannot simply print unlimited money without risking a decline in purchasing power. If debt levels continue to rise, borrowing more becomes increasingly expensive. The tools that solved previous problems may not be as effective in solving future ones. One of the biggest misconceptions is that economic crises arrive suddenly. In reality, most crises develop slowly and then appear suddenly. The warning signs are often visible years in advance. People ignore them because the system continues functioning. Businesses remain open. Consumers continue spending. Markets continue rising. Then eventually a tipping point arrives. Confidence begins to weaken. Investors demand higher returns to lend money. Borrowing costs rise further. Economic growth slows. What seemed manageable yesterday becomes dangerous today. When I study history, I often look at long-term debt cycles. These cycles can last decades. They begin with borrowing, investment, and growth. As confidence increases, debt expands faster. Asset prices rise. People feel wealthier. Governments spend more. Businesses become more aggressive. Eventually, debt reaches a point where growth, generated by new borrowing, begins to decline. More debt produces less economic benefit. That is when vulnerabilities begin to emerge. We are seeing signs of this dynamic today. Another factor that concerns me is the growing gap between wealth and opportunity. Throughout history, periods of financial stress are often accompanied by social and political tensions. When large portions of the population feel left behind, dissatisfaction grows. Economic inequality becomes more than an economic issue. It becomes a political issue. Different groups begin blaming one another. Political polarization intensifies. Finding compromise becomes harder. These pressures can make economic problems more difficult to solve because solutions require cooperation. At the same time, technological change is accelerating. Artificial intelligence has the potential to transform industries, increase productivity, and create enormous value. But technological revolutions also create disruptions. Jobs change, skills become obsolete, entire industries evolve. While innovation ultimately benefits society, the transition can be challenging for millions of people. We may be entering a period where economic opportunities expand for some, while uncertainty grows for others. Managing that transition will be one of the defining challenges of this decade. The global landscape is changing as well. For many years, globalization helped reduce costs and increase efficiency. Supply chains stretched across continents. Capital moved freely. Trade expanded. Today, geopolitical competition is creating new risks. Countries are becoming more focused on security, resilience, and strategic independence. This shift may improve stability in some areas, but it can also increase costs and reduce efficiency. The world is becoming more fragmented, and fragmented systems tend to be more expensive and less predictable. One reason people underestimate major risks is that they assume the future will look like the recent past. Human beings naturally extrapolate trends. If markets have performed well, they expect markets to continue performing well. If economic growth has been steady, they expect stability to continue. But history is full of periods when assumptions suddenly changed. The greatest risks are often the ones that few people are discussing because they fall outside recent experience. Consider the impact of rising interest payments on government finances. As debt grows larger, interest costs consume a greater share of resources. Money that could be used for infrastructure, education, healthcare, or innovation is redirected toward servicing debt. This creates difficult choices. Taxes may need to rise. Spending may need to be reduced. Additional borrowing may be required. None of these options are painless. The larger the debt burden becomes, the fewer attractive choices remain. Markets are remarkably efficient at ignoring problems until they can no longer be ignored. Investors often focus on short-term earnings, quarterly reports, and immediate trends. Long-term structural issues receive less attention because they unfold gradually. Yet the most significant economic events often emerge from those long-term trends. The challenge is recognizing them before they become obvious to everyone else. I often tell investors that risk is not what everyone sees. Risk is what people don't see. When everyone worries about a recession, markets often price in those concerns. The greater danger may come from factors that are not fully appreciated. Today, I believe one of those risks is the interaction between debt, interest rates, and declining financial flexibility. These forces can reinforce each other in ways that create unexpected outcomes. So, what should individuals do? First, avoid panic. Fear is rarely a productive strategy. Economic challenges create risks, but they also create opportunities. The goal is not to predict every event. The goal is to build resilience. Diversification remains important. Financial flexibility remains important. Reducing unnecessary debt remains important. Investing in skills, education, and adaptability remains important. People who prepare for uncertainty tend to perform better than those who assume stability will continue forever. Second, focus on what you can control. You cannot control interest rates. You cannot control government policy. You cannot control global events, but you can control your savings rate, your spending habits, your investment decisions, and your willingness to learn new skills. In uncertain times, these factors matter more than ever. Third, think in probabilities rather than certainties. Too many people search for definitive answers. They want to know exactly what will happen and when it will happen. The world doesn't work that way. Successful decision-makers think about scenarios. They evaluate possibilities. They prepare for multiple outcomes. This approach doesn't eliminate risk, but it improves resilience. The next decade may look very different from the previous decade. The era of extremely low interest rates, abundant liquidity, and easy financial conditions may not return in the same form. Governments, businesses, and individuals may need to adapt to a world where capital is more expensive and economic trade-offs are more difficult. Those who recognize these changes early will be better positioned than those who continue operating under outdated assumptions. When I say that something worse than a recession could be coming, I am not predicting catastrophe. I am highlighting the possibility that we are facing structural challenges rather than cyclical challenges. Recessions come and go. Structural shifts reshape the environment itself. They alter incentives, opportunities, and risks for years rather than months. Understanding that distinction is critical. History teaches us that every major challenge eventually creates new opportunities. Periods of disruption often produce innovation, entrepreneurship, and renewal. The future is not predetermined. The decisions made by governments, businesses, and individuals will influence the outcome, but ignoring warning signs has never been a successful strategy. The best approach is to face reality honestly, prepare thoughtfully, and remain adaptable. The biggest mistake people make is assuming that tomorrow will look exactly like today. The world is changing. Economic conditions are changing. Financial systems are changing. The question is not whether change is coming. The question is whether we will recognize it early enough to prepare. Because if history is any guide, the people who understand the cycle before everyone else are the ones who survive uncertainty and emerge stronger on the other side. And that's why I believe the most important conversation today is not about whether a recession is coming. It's about whether we are prepared for something bigger, a challenge that goes beyond a normal economic slowdown, a challenge rooted in debt, demographics, politics, technology, and global change. If we understand those forces, we can navigate them. If we ignore them, we may discover too late that the real risk was never the recession itself. It was what came after it.